Have you heard about the very famous car brand called Ferrari? Well, they make super expensive race cars and it's very Italian. If you look at the shape, it's very special. And in today's video, we are going to check out how is their stock doing, because if you can't afford like a Ferrari like me, you can maybe get the shares and then receive some of the profits throughout owning the company actually. So one of my viewers have mentioned this. If you have other stocks that you would like to get analyzed, just type it down in the comment section and I will do it. So the ticker symbol is RACE, and if we plug it into our Google Sheets, it will automatically load in all of the data that we will need for this analysis. We are going to do a discounted cash flow model, a simplified discounted cash flow model. So there will be an exact share price that I think that it would be worth buying the company. So stay tuned until the end of the video. And if you would like to get the automatized Excel sheet, you can just buy it for a few bucks down in the description section. So make sure to check it out and support my work. So if we want to figure out how actually Ferrari makes its money, we will have to load in this very beautiful table made by Guru Focus, and we will see that they are operating through one single segment. Mainly they're selling the cars through different dealerships and the car brands. But their main segment is only one, where they make $7 billion US, and you will see that the cost of goods sold is about 50%. So you will see a large gross profit margin, about 50%. It's extremely high for an industry. So if we would look at other car companies like Volkswagen or Stellantis, we will see very small margins. Obviously, this is a luxury brand. It comes with a huge price. If you buy an Apple, the margin is different than if you would buy a Samsung. Of course, the differentiation buying a Ferrari or buying a Polo is much different. But you can get an imagination how much money they actually make by selling luxury items, and at the end of the game they will make 22%, almost 23% net income margins at the end. If you look at here, it's extremely high. So you get a picture that this company is extremely profitable. The stock has been rising even though there has been some financial issues in Europe and also in the United States, but you can get an imagination. Someone who can afford a Ferrari, it doesn't really matter if there is a financial slowdown, because they are so rich that buying a Ferrari doesn't make a difference at all in their life. So you will get a sort of picture that this company could be a very good defensive stock and you might need to pay a premium for it. So the current issue with the company is, for my example, it's very high priced in, and we will see why. You can see that the stock price has risen very nicely in the past 10 years. So there is no issue in stock growth, but let me get to the point. So their price to earnings ratio is 47. So you get a picture that it's, if you just look at it, their net income versus their price, you will have to pay a lot of premium for it. But let's see their cash flow. Their price to free cash flow is even higher, meaning that this company is priced at the premium just on the ratio basis. But we will get into the discounted cash flow where we will take off all their debt, we will take off everything, and we will see what would be worth to pay for this company. So they pay a little dividend. Their payout ratio is about 35%, which is very healthy, and the dividend current yield is 0.61%. What is amazing about this company is their return on equity, which is 46%. That's amazing. If I am looking for a company, I'm usually taking the 15 to 25 area where I would be very into the business to look more into it. So looking at a 46.7%, I am very interested. As we discussed before, their gross margin is 50%, operating margin 28%, which makes the free cash flow margin to 22%. Amazing. Everything looks very nice. Look at their liquidity ratios. We can see that their current ratio is 1.47, which is very healthy. If we look at their debt to equity ratio, it's also okay. If we look at the long-term debt per equity, you will see that it's a little bit less good as if you would look, but still very healthy. They have a good cash amount, although we will check into their balance sheet very, very soon. Looking at their growth indicators, we can see that they will have very steady growth in the past next years. Even though we are looking into a financial turmoil, we can see that this company projects to have a pretty good growth in the future. So let's check their dividend payments, how long they have been paying dividends. We can see that they're being able to raise their dividends year to year quite nicely in the past years. So this could be a good option if you are looking for an increasing dividend payment company and also an increasing stock raising company. So if you look at the employees, they also have been growing quite heavily with their employees. There has been a 9% growth in the last year to 2013, and we will see what's going to happen in 2025. Let's look at the analyst options. You can see that the analysts are usually maintaining their buy and hold or strong buy positions, so there is no sell sign right now at this point. We can see that the targets are around the 550s, so there could be a little growth potential still in the company. We will see the discounted cash flow, why I would say let's not do it. But of course, people to people, it differentiates. I am a long-term investor. So for me, I'm looking for an undervalued company. If we look at their income statement just very briefly, we can see that their revenue growth year over year is with a nice double-digit number. So you will see 20, you will see 19, 17. Everything is super good. Their gross profit is increasing. Their selling and general admin costs are not increasing as much. And if you look at their net income, where you will see, well, they are quite heavily profitable. We have seen it before, but you will also see now how their net income is also growing by double digits. So everything looking very healthy in the current situation. About the free cash flow is steadily growing, and you will see a little buyback into the shares, which can also have a positive effect on the share prices. So everything is clapping together. Why am I saying I'm still very, very, well, not bullish or not bearish, but I would say not buying this company, and that the reason it has been overvalued for a long period of time. If we look at the ratios are always have been very, very high, meaning that there are high expectations for growth from the investors, and they are pricing this in. So if we look at the PE ratio, it has been steadily up in the 40s. And if you look at the price to free cash flow, also it has been there. Their market capitalization has almost doubled in the past 5 years. So you can see that this company has developed a lot, but although it has a high price. So let's get into the discounted cash flow, simplified discounted cash flow. And for this, we will need the lines from here. So we will just simply put the cash flows into our financial positions, and it's very simple. So what are we going to do? We are going to just plug in the free cash flows right here. If you get the Excel sheet, you can just do it how I do it. It's very simple, very easy, almost fully automated, so you don't need to even think about it. So what we do is we take the 5 years average cash flow growth, and we will see a growth number for these past years. You can see that it is 35%, which means in the past 5 years, if we look at the total average, that has been 35% growth, which is amazing. Let's project their growth. Let's go, for example, with 20%. Just 20%. You will see that the sheets will automatically load in the data. It will put all the future cash flows, and we will need to count this back to present value with the discount rate, and we are going to use the WACC, the weighted average cost of capital, for that. So we're gonna just stick to this perpetual growth rate. We are going to decrease it to 2.5% just to be in a little bit safe haven. And we are simply just going to go into the discount rate. So as you can see, everything is set up now. We can see that the discount rate is currently set to 9%. Our margin of error is 2%. So let's head in and pop in 11.57 and we will get to around 12% discount rate. And this will show how the future cash flows are going to be brought back to the present value with the discount rate, including their cash and equivalents, their total debt, and then we receive the equity value and we just divide it by the outstanding shares. We receive that the stock price should be or around 160. You can have the imagination. All right, then how is it currently 423? If my accounting is 160, well, we should have to go back and just use a different growth rate and then just use a different discount rate. So this is where my question comes in. Do I think that this company can sustainably grow at a 25% rate as they have done in the past 5 years? Well, you will have to take a deep into that question. But if I would just put the WACC back to the 9%, I will still receive a 412, where you can imagine that it is head-to-head with the current price. So if these circumstances are qualified for the next 5 years, then you can say I would pay this amount of money for this stock, but the premium which you will receive will differentiate depending on how the stock will perform. So my takeaway from this is it's an amazing company with a beautiful growth. I'm loving to see this from the side, but I don't want to buy into this one because for me, it is looking too much overpriced. So if you like this video, make sure to check out these automated Google Sheets and you will get the links down in the description and you can support my work. And don't forget to put a stock ticker into the comment section so I can analyze it for the next video. See you in the next one. Goodbye.